All about expected moves. John, first
do it.
slide. Option
ask a lot of
prices
questions.
provide an expected range for an underlying in a given period. This is called the expected move. We've been, I don't know, talking about this for 15 years on Tasty now. And it's all over the platform.
Yep.
Okay, let's go next slide.
Super cool concept. Really important for options
Yeah.
trading.
Here we go. Now we start to get in. So the approximation of the Tasty formula. You want to. This is how far we've come over the years. When we first built expected move, going back to when we built the Thinkorswim platform, we had a very basic formula. It wasn't very good. Well, we introduced it. I called it the market maker move.
The market maker move.
Because that's what we would. Yeah.
And
we basically took. We took the front month straddle, and then we took the back month. We took the 30-day strangle, and then we took the nearest out of the money strangle.
Yeah.
We took the straddle and strangle. We added them together, divided by 2. Pretty basic.
It is pretty basic, yeah.
Okay, but that's how traders on the floor used to do it. That's why we call it that.
Sure.
At Tasty, we decided, okay, we're going to spend a little more time. We're gonna smooth this out a little bit. So we take 60% of the at-the-money straddle price, 30% of the first strangle price, and 10% of the second strangle price to give ourselves, kind of a little bit more of, a little bit bigger circle.
A little bit of a more well-rounded calculation.
Yes.
And for context, right, so we use 68% to define the expected move. We're really trying to capture 68% of the, moves over some forecasted period of time. That comes from like the normal distribution, which we use all the time in quantitative finance, right? And so something that options allow you to do that you don't necessarily get to see when you're just using stock price signals is you can actually see, based on how investors are buying and selling contracts, where investors expect the market to be. And so effectively what we're doing is we're taking those expectations that are reflected in the prices of these different option contracts, and we're weighing that out to get a really rough gauge, a symmetric gauge of where we expect the stock price to wind up by expiration 68% of the time. Right.
Expected move for premium sellers like me, give us a strike to sell. Expected movers from people that are just buy or sell stocks or futures is great because it gives you a target.
Right.
It is reasonable.
Exactly.
Let's go next slide, John. The theoretical percent of the time that the actual moves are less than the implied moves is, let's just say, about 70% of the time. For equities, however, it was much higher. This suggests that markets are less volatile than anticipated by option prices.
Right.
So, that's the beauty of like what we do, which is saying, okay, SPY, go beat us. Okay, Qs, beat us. So 68% expected, 86, 78, and 85. That does not take a rocket scientist to see why we sell premium.
It doesn't. And it's a really interesting picture. And again, remember that like the way that we're calculating expected move by using the option prices, we're using investors' expectations around the future to gauge where approximately we expect prices to wind up. And what you see here is that like investors just tend to overstate, their fear tends to overstate what actually happens more than actually theory would expect.
Sure.
Because investors tend to freak out sometimes.
Next slide, John.
It shows. Yeah.
So the commodity ETFs that we like to trade saw similar expected move overstatement, but not to the extent of equity indices. So crude oil, gold, and silver, much closer to that expected 68%, but all of them are still over it. Let's go to the next slide.
Yeah.
Individual stocks also showed similar overstatements in expected move. All markets had overstatements in their 45-day expected moves, but we're going to explain why in a little bit. Next, we're going to test the overall market in various IV environments over 15 years. But Amazon 77, Goldman Sachs 76, Google 78, and IBM 85. That's the argument for selling, premium outside the expected move or just selling premium on both sides.
Sure. And I'm actually not surprised by these results, seeing like the single company names tend to kind of overstate more often, just because like I would expect like Amazon to probably have like more speculation involved potentially in the prices compared to like a commodity that's some kind of like fixed level of production or something like that. That's kind of.
Let's go to the next slide, John. Yeah. So then we went back and looked at the SPY in 15 years, and there's a lot in this one. Okay. The average realized move, the average expected move, the breaks to the upside, and the breaks to the downside. This kind of define where are we right now? We're in the 0 to 20 because vols come down a little bit.
Yeah.
But we've been in that 20 to 40 range. You can see how the risk goes up pretty significantly in that 20 to 40% range in both sides, actually. But
both sides.
But you can see, and that's where we just were in this is IVR. I'm sorry.
This is IVR. Yeah.
This is IVR. IVR. Yeah. It's hard to say.
I think this still also holds true, right? I think SPY's IVR is 21 actually, so we're a little closer to that, right on the cusp.
Okay. I mean, listen, this gives you a pretty good indication of the difference between the average realized move and the average expected move. I mean, that's your cush.
That's your cush. And what you can actually see, minus IVR over 75, and that comes with a caveat, which is that that has to be like 5 to 10 occurrences.
It's not a lot.
It's not a lot. So just like the uncertainty on those calculations for IVR over 75 are very high. But that being said, when you actually look across the chain, you do actually see a spike around 20 to 40. But overall, it's actually pretty consistent. Like when you're looking at IVR from 40 to 75, you're seeing pretty comparable levels from when it's 0 to 20. So you're seeing it actually break out of the expected range minus 75 plus, and to an extent 20 to 40, about the same frequency. Which is
I just
really
like looking at the numbers to see how big a difference it is between the average realized move and the average expected move, so people understand why we do what we do.
Sure.
And the percent breaks, the upside, the downside, are all in that 10% range, and so that's what you're up against. I mean, that's pretty fair.
It's pretty.
Let's go to the next slide. I mean, it gives you realistic expectations. Because the Tasty platform only gives you expected move for expirations, traders may want to calculate the potential daily expected move for each underlying. I mean, we do give you for expirations, but there's a lot of expirations. So like if you're doing like the SPY or the SPX, there's an expiration every day.
Yeah.
So you can get the daily. But this is done using the following formula if you want to do it for an individual stock. However, it can be clunky to use this formula due to the possibility of calculating the square root of a non-integer number.
It's also less accurate than some other methods. It is less accurate than some other methods, and I think like kind of something worth noting for both of the methods that are shown here is that you get a symmetric expected range. To the upside, it's the same length as the downside.
Yeah.
But what we see on the actual chain is skew, right? And so there's another method that's maybe not highlighted here, which is that you can actually use the 16 delta strikes to account for that skew, to say like how much larger is the expected range to the downside versus the upside, for example. So that's just kind of another method here. But this is a pretty simple back of the envelope calculation that can be very helpful if there's not a strike available for estimating expected move.
Next slide, John. Instead, traders are able to simplify the math by using the following formula to calculate the daily expected move. And so if the implied volatility of an underlying is 19%, its daily expected move is roughly 1%. And if it's 38%, it's 2%. I mean, I've seen people use 19. I've seen people use 18, 17. You can really, it's got a little bit of wiggle room in there, but there you go. So we use this a lot, just to back of the envelope type thing.
Yeah.
If you have, for example, a 54% implied volatility, your daily expected move is going to be about 3%.
Sure. Yeah. And I'm sure this is like probably close to what you did in your head in the pits, maybe.
Well, the difference in the trading pits was that you don't get to do what you want to do anyway, so it doesn't really matter.
Okay, that's a fair point.
Just taking the other side of what anybody else wants to do, so it doesn't matter what you want to do.
There's pure anarchy and chaos. I love that.
Let's go to the next slide. So the math, we have a little here.
A little bit more math.
Thus, find the volatility of an underlying on the Tasty platform divided by 19. You have an easy approximation of the daily expected move, and that's very fair. Lots of different ways to do it.
Easy peasy.
Last slide, John. So expected move is a useful measure of an estimated move in an underlying price, calculated using the weighted average of the prices of the at-the-money straddles and the closest out-of-the-money triangles. 60, 30, 10 we use. Traders use implied volatility to estimate the daily expected move position, calculated via at-the-money straddles and out-of-the-money strangles. Expected moves based on implied volatility tend to overstate the actual market moves, especially for indexes and individual stocks. And the discrepancy between expected and realized moves is part of what provides option sellers with a statistical edge.